In 2008, the global financial system faced one of the most severe crises in modern history. Markets across the world began to fall almost simultaneously. Banks stopped trusting one another. Credit markets froze. Businesses struggled to access funding. Ordinary people felt the consequences quickly. Jobs were lost across multiple industries. Homes were repossessed at record levels. Retirement savings declined sharply. Governments were forced to intervene on an unprecedented scale. This crisis did not appear suddenly. It was not caused by a single institution. It was not triggered by one bad decision. It developed slowly over many years. Risk accumulated quietly inside the financial system. Complexity helped hide that risk. Incentives encouraged it to grow. Warning signs were ignored until the system could no longer support itself. To understand 2008, it is necessary to go back to the foundations of the housing market. For decades, home ownership was promoted as a path to economic security. Governments supported it through policy. Banks viewed mortgages as stable assets. In the early 2000s, interest rates were historically low. Borrowing became easier than before. Lending standards gradually weakened. Banks approved loans for borrowers with limited income. Credit histories mattered less. Documentation requirements were reduced. These loans were known as subprime mortgages. Many of them carried adjustable interest rates. Initial payments were low and affordable. Later payments were significantly higher. Lenders assumed housing prices would continue rising. Rising prices appeared to reduce risk. If borrowers failed to pay, homes could be sold at higher values. This belief shaped lending behavior. More loans were issued every year. Housing demand increased rapidly. Prices rose faster. Confidence grew stronger. Skeptical voices were rare. Optimism dominated decision-making. The housing market became overheated. Risk accumulated silently beneath rising prices. Banks did not intend to hold these mortgages for long periods. Instead, they packaged them into financial products. Thousands of mortgages were bundled together. These bundles became mortgage-backed securities. Investors around the world purchased them. Pension funds invested heavily. Insurance companies followed. Hedge funds participated aggressively. Risk appeared diversified across many loans. In reality, it remained connected. Credit rating agencies evaluated these securities. Many received high ratings. Even securities backed by risky loans were labeled safe. Investors trusted these ratings. Demand for mortgage products surged. Financial innovation accelerated rapidly. New products were created to meet demand. Collateralized debt obligations became widespread. These instruments repackaged existing securities. Layers of complexity were added. Mathematical models were used to justify safety. Assumptions replaced careful analysis. Historical data was limited. Extreme scenarios were underestimated. Risk appeared to disappear through structure. In reality, it became harder to see. Profits grew quickly across Wall Street. Bonuses increased dramatically. Competition intensified among institutions. Standards declined further. Complexity discouraged scrutiny. Few people fully understood the products. Even fewer questioned them. Trust replaced verification. The system became increasingly fragile. Fragility remained invisible during expansion. Growth continued uninterrupted. Incentives shaped behavior at every level. Mortgage brokers earned commissions per loan. Loan quality mattered less than loan volume. Banks earned fees by packaging and selling products. Long-term performance was secondary. Traders were rewarded for short-term gains. Executives were compensated with stock-based incentives. Rising prices boosted compensation packages. Rating agencies were paid by product issuers. Conflicts of interest were built into the system. Regulators relied heavily on self-reporting. Oversight remained limited. Markets were expected to self-regulate. Risk models underestimated rare events. Stress tests were insufficient. Leverage increased significantly. Small losses became dangerous under high leverage. Liquidity depended on confidence. Confidence depended on prices. Prices depended on borrowing.
Borrowing depended on trust. Trust became increasingly fragile. The system relied on continuous growth to survive. In 2006, housing prices peaked. Growth slowed gradually. Prices stopped rising in many regions. Adjustable-rate mortgages began resetting. Monthly payments increased sharply. Borrowers struggled to keep up. Defaults increased steadily. Foreclosures became more common. Housing supply expanded. Prices began to fall. Mortgage-backed securities lost value. CDOs declined rapidly. Losses spread across institutions. Confidence weakened throughout the system. Liquidity dried up. Interbank lending slowed dramatically. Institutions questioned each other's exposure. Transparency was lacking. Fear spread quickly. In early 2008, Bear Stearns collapsed and was rescued. The warning was clear. Markets remained unstable. Lehman Brothers faced mounting pressure. Funding sources disappeared. No buyer emerged. Government support was withheld. Lehman Brothers filed for bankruptcy. Panic followed immediately. Money markets froze. Credit default swaps surged. Insurance giant AIG required emergency support. Governments intervened to prevent total collapse. Banks were rescued or nationalized in several countries. Trillions of dollars were committed globally. Stock markets plunged worldwide. Global trade slowed sharply. Manufacturing activity declined. Unemployment increased across economies. Emerging markets experienced capital flight. Europe entered recession. Asia felt reduced demand. Consumer confidence collapsed. Spending declined sharply. Investment slowed. Economic contraction spread globally. Central banks cut interest rates aggressively. Quantitative easing programs began. Gradually, stability returned. Recovery was uneven and slow. Some institutions survived. Others disappeared permanently. Households bore significant losses. Wealth inequality widened. Public trust in financial institutions eroded. Political consequences followed. Regulatory reforms were introduced. Capital requirements increased. Stress testing improved. Oversight expanded. Awareness of systemic risk grew. Financial innovation did not stop. Over time, memory faded. Markets recovered. Confidence returned slowly. Debt levels increased again. Complexity returned. New risks emerged. The 2008 financial crisis reshaped global finance. It reshaped regulation. It reshaped economic policy. It reshaped millions of lives. Understanding 2008 remains essential. Financial crises do not repeat exactly. Patterns reappear in new forms. Incentives continue to shape behavior. Transparency remains critical. Accountability remains necessary. Stability requires constant vigilance. Growth requires restraint. Risk must be understood, not hidden, not ignored. The 2008 financial crisis was systemic. It was created by human decisions. It was preventable. Its lessons remain relevant. Financial systems evolve. Human behavior changes slowly. Awareness matters. Memory fades quickly. This story still matters today because systems are built by people, and people respond to incentives. Understanding the past improves the future. That is why the events of 2008 must be remembered.